Good morning. It is Monday, February 24th, 2025. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. As a reminder, this presentation is designed by me for use with both financial advisors as well as individual investors. Of course, each are expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, or a recommendation for the purchase or sale of any securities. Views expressed herein are mine and mine alone. They may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Well, looks like sort of the euphoria resulting from the election has faded, at least in the equity markets for now. We gave back a pretty good chunk of this year's gains. You can see the S&P 500 down about 1.6% on the week, and so now giving up about half the gains. Not a big deal. It was a very orderly sell-off. Small and mid-cap stocks sold off much more. They're now actually negative for the year, barely so, but negative nonetheless. The only thing that really did well last week, continued to do well, was emerging markets. Emerging markets are up 2%. Bringing the annual gain to 7%, just behind the developed international EFI index gains for the year, which are a little over 8%. On the sell-off in equities, as you would expect, we cut a bid on fixed income, 20-year plus Treasury bond index up 47 basis points. I saw the 10-year yield down below 440 for a brief time. And high yield did not participate. In fact, it was off just a tiny bit, so that means spreads widened out, but from an incredibly low, historically low level, remain historically low. But it was definitely a risk-off week, first one we've had in a while. We saw it in equities, and then we kind of saw it, a little bit of a move there. We saw it in high yield. I've been talking about Merger ARB for a while. It's our alternative position. You can see the Water Island Merger ARB index last week up in what it's supposed to do, right? When the equity markets are not doing so hot, it's supposed to be an absolute return vehicle, non-correlated, and with the new FTC, with Lena Khan being out, deals getting approved, we're sort of liking this now up a little over 2% on the year. Economic data last week was, it was mixed. There was some surprises in there, and some things that were not surprised. One is home builder sentiment remains incredibly low. Came in at 42. It was below the estimate, below the prior month. Present sale component back below 50. Expectations dropped a lot. Traffic fell to, a 29 is just an incredibly low reading on traffic. Basically, people are concerned about mortgages and interest rates. They've gone up because inflation's not going down. In terms of if you go short adjustable, the Fed is not cutting rates, again, because of inflation. And then also people having concerns about inflationary costs of everything else they consume and how those might be impacted by proposed tariffs. Housing starts, that's new homes being built, fell almost 10% in the month of January. That they had a huge gain in December, up 16%. But this decline was not surprising. It was across the board. Multifamily, single family, all fell, and then existing home sales remain down. They remain low. We had a couple of months, you can see here, 1, 2, 3 months in a row of gains from very, very low levels. And this month, or in January rather, they fell about 5%. That was almost double what was expected. And you can see at this 4 million or so annualized pace of home sales, which we've been at for about 3 years. That's down from 6.5 million during the heyday of zero interest rates and COVID. Initial weekly claims for unemployment came in at 219,000. They remain very low. Job market, labor market is strong, which means the consumer's strong, which means earnings are good. And we keep going there. We're trying to look through the data. Do we see any cracks anywhere? I don't know. Let's take a look at a couple of the regional manufacturing surveys and then the two national flash surveys that we got from ISM. We'll start with New York State manufacturing. It turned positive, but you can see it's been mostly negative for the better part of about 4 years. Did have a positive reading. New orders went positive. Shipments went positive. Employment, however, went negative, and the outlook stayed positive, just not as positive as the prior month. Philly Fed survey, this is now back-to-back positive months, so this is good. It's starting to suggest, well, maybe, just maybe, we're going to see the broader national readings, which I'll get to in a minute. February Philly Fed fell to 18.1, but that's above zero, so that's a positive number. New orders positive but lower. Shipments positive but lower. Employment positive but lower. And the outlook the same, positive but lower. Then we get into the national readings. Start with manufacturing. Remember, manufacturing is about 15% of the U.S. economy. Here, 2 months in a row above 50 in manufacturing, after 1, 2, 3, 4, 5, 6 in a row below the 50 reading. Came in at 51.6. It was a little bit above the estimate of 51.4. If we can start stringing together 3, 4, 5, 6 months, then I think you can start having the conversation about, is manufacturing back? I know that's an important goal of the administration. But then, just when we thought things were starting to get better, out of nowhere, the services sector contracts. It actually contracted. Fell from 52.9 to 49.7. Now that's close enough to 50 that we could say, you could argue it didn't contract, and I think that would be a legit argument. But it is the lowest reading we've had in services, which is 85% of the economy. Lowest reading since January of 23. Employment contracted. And if there's any good news in this, it's that both prices charged, these are subcomponent readings, prices charged and input prices both fell. So they instead of going up, they actually went down. Prices went down month over month in this particular survey of services. Barely, right? 49.7 again, but below 50 means they went down. And lowest reading there for those since May of 2020. That could potentially bode well for future inflation readings. But as you know, the ones I've been giving you the last couple of months have been very, very horrible. We then go on to University of Michigan consumer sentiment. Fell from 71.1 to 64.7. That was below estimates. Current condition expectations both fell. Why? People are concerned about, again, it's the same two topics, tariffs and inflation. And this you can see where this is much lower than we've had. Really, you got to go all the way back to late or early 2022 to get a reading below this. So people are starting to get a little nervous. I think it is, as I mentioned last week, it really has to do with policy uncertainty. Uncertainty just continues to grow, and when you have uncertainty go up, that usually leads to more volatility, downside volatility in the markets. Let's wrap up the earnings quarter. 429 of 500 names have reported. 327 have beat. Average earnings surprised close to 7%. Consumers strong. Look at that. Consumer discretionary earnings, average surprise there almost 17%, almost 11% in financials. Only one that's been negative so far is industrials. And that's just barely across the negative line. Well, the market obviously went down last week. That happens. We all know that. It's part of investing. But boy, did my phone ring. And my phone rang with a lot of people with a lot of concerns. I think a lot of it has to do with the fact that, the political landscape is shifting. Domestic political landscape is changing as a result of the election. That creates uncertainty. And uncertainty creates a little anxiety. Little anxiety gets exacerbated with a decline in the market. But let's put this decline in the market in perspective. It was just a little over 2% from an all-time high the week before. So it's very common when you get to all-time highs, like let's say this one, that the market then has a little pullback and a correction. People take profits sometimes. We got to another all-time high here, a little profit taking, another new all-time high here, and a little profit taking. Could there be more? Absolutely. I think there could be more. But as I always say, predicting a market correction or pullback is one thing, but trying to preempt it with a trade is usually a exercise in futility, does more harm than good, and I think it's always best to be one who reacts to market corrections rather than tries to predict or preempt market corrections. Why do I think it's likely? Well, I told you about the policy uncertainty, but the other thing is just valuations, right? Valuations remain high on stocks. This is a PE multiple graph of the S&P 500, blended forward 12 months earnings estimates, consensus on the Bloomberg terminal, so pretty good reading. You can see we ended 2022 at about a 15 multiple. We're now at a 22 multiple. Well, that's 50% higher. And we've had tremendous equity market returns in 2023 and in 2024. We got the good returns because we had great earnings growth, but we also had 50% multiple expansion. Multiple expansion is not likely to continue to go up another 50% in the next 2 years, right? That would put us at a 33 PE on the S&P 500. And I just do not see that happening. So I think returns for the next couple of years, even though the economy is good, even though earnings are good, I think the returns will be muted. And I think it's more likely than not that we get that correction, and we get it in the first half of this year. So keep your cash. It might be a good idea. Having cash available to invest, should it occur, could prove it good. The other thing I mentioned, the PE, and I've been talking about the policy uncertainty. This is the Global Policy Uncertainty Index, and you can see it hit an all-time high there just about a week ago. Get an all-time high in policy uncertainty, you should expect higher volatility and higher equity risk premiums. And the equity risk premium is very, very low when you have a 22 PE. Economic data this week, nothing today, Monday. FHFA house prices, Case-Shiller house prices will come tomorrow. Consumer confidence, new home sales, weekly claims for unemployment, as always. Fourth quarter GDP, 2.3, expect no change from the preliminary. Durable goods, pending home sales, personal income and spending, and the big one, the January PCE price index. This PCE index is the gauge the Fed uses to determine whether or not they're meeting their statutory mandate of price stability. And then on Friday, we'll have Chicago PMI. I'm Herb Morgan. This is Slaying Bulls and Bears. We aim to make the complex and complicated simple and sensical. Thank you for tuning in. I'll be back to you again in 1 week.